We're live now. 1 minute.
Fantastic. Welcome, everybody, to the Gulf Intelligence Global Energy Outlook Forum for 2025. We are so excited to talk a little bit about the outlook for U.S. energy industry, supply and demand under Trump 2.0. Brent is trading right now approximately 76.50. WTI is trading about $2 south of there at 73.60. Last year in 2020, as we were entering 2024, there were a lot of questions about what the outlook would be for 2024, such as will the continuation of 2023's growth cascade into 2024? Will the U.S. add another million barrels a day of production in 2024? There were a lot of questions around China because their growth patterns in 22 and 23 were phenomenal. And questions about Guyana, Venezuela, non-OPEC supply. And now entering 2025, we have a new presidency in the U.S. and under Trump 2.0. And fortunately, I am joined today by Mr. Mike McGlone, a senior macro strategist for Bloomberg Intelligence, as well as Dr. Sara Vakhshouri. She is founder and president of SVB Energy International, and Richard Redoglia, who is the CEO of Matrix Global Holdings. And I'm actually going to lead off with Richard. Richard is located in California, so thoughts to everybody that is around you, because you guys have been impacted with wildfires, and our thoughts and prayers are with you. So I wanted to start with you just in case you have to jump off and evacuate the facility. So I thought let's go ahead and jump right in. So how might a Trump 2.0 impact crude oil production in the United States, particularly in the Permian Basin? What are your thoughts there?
Thank you for having me. Fortunately, I'm in North County, San Diego, so far from the fires, but a lot of friends and family up in the LA area. So hearts go out to them. I don't think it does much. I think that the Permian Basin has been changed from where we were last year. Really going back, we have to kind of go back about 3 years now. I think that what we have seen in the Permian Basin is an increase in demand of supply. I think we're up to around 13 million barrels, 13.1 million barrels, probably heading up to around 13.7, 13.8. But I think what that has been a function of the large super majors taking it over. And the super majors, by taking it over, have changed, I think, the output profile of the Permian significantly. It has gone from the hands of those who want to make a quick buck to those who want to make sure that they have a form of supply going on for the next 10 to 20 to 30 years into the refinery systems in Houston. And if you want to know, Exxon has built it's expanding its pipeline into Baytown continually now. And so I think that's really the key there, is that one of the things that we've seen, I think that's one of the key factors, if you go back in time, is that price of oil is a balance between non-OPEC and OPEC, controlled by OPEC and really controlled by Saudi Arabia. And Saudi Arabia in 86, in 99, in 14, in 16 and 20 is always the country that determines where the price of oil is really going to be, because they had the marginal supply. I think we're in a situation now where the U.S. majors and OPEC are aligned. I think they're happy to have the price in a reasonable range that is profitable for all, that allows them to do long-term planning, allows them to make money on the refinery side as well. And so I think what we're really looking at is that, and I think you made a point earlier before we got on, Brian, which is a good one, is that Trump 2.1, or excuse me, Trump 1.0, the increase of oil production there was just a coincidence. And I think it's proven by the fact that production went up under Biden. The U.S. production went up under Biden, even though all of the other things that went on as it relates to offshore drilling and the like. It's really the marginal production in the Permian and the Bakken and the other, but the Permian in particular, that was where the marginal production came in, and it didn't matter who was in office. And so I think now what we're really looking at is a kind of a don't look at this right now. The bigger issue is going to be, and I think this is the issue we should be looking at going forward, is what's going to happen in LNG production and what's going to happen in LNG exports. And I think that to me is the key. And as an oil guy for 45 years, I want to I think oil, unless something radical happens, is just going to be where it's going to be for a long time, unless we see something political happen that causes the price to fall or rise because of a war. But I think right now, I think we're going to Trump 2.0 as it relates to the Permian is a non-event.
Yep. Okay, fantastic. Thank you, Richard. Dr. Sara, I wanted to chat with you a little bit about U.S. producers versus the national oil companies around the globe. And when you look at that, the driving force of U.S. producers versus national oil companies, what do you see into 2025 as producers in the U.S. in particular, since there was a lot of growth in the U.S. as well as Guyana and Venezuela? What do you see as producers in the U.S. which have a lot of productive capacity to bring on more, but they haven't really brought on enough rigs to really ramp up production, whereas national oil companies are looking at budgets and how to balance those? How do you reconcile them? What does your crystal ball say for 2025 when you look at supply from, say, the U.S. and national oil companies?
To answer that question, I would like to pick up from what Richard said, and just to make this distinction between U.S. energy companies and national oil companies. It was mentioned that the U.S. policy and who is in the office doesn't make really much of a difference on U.S. energy production, because that's a decision usually made and invested by the companies. And while this could be at some point challenging for U.S. government in terms of, let's say, they don't have the flexibilities of governments with national oil companies that they could decide regarding the production, or even within their energy diplomacy, because what U.S. government or president decide is not necessarily impacting the investment decisions of the companies. So what I would say the major difference is that the U.S. energy companies are more capital disciplined. They look at where they can make the profit. They are more, they're also, their decisions in terms of taking risk and resilience is obviously much different, more different than the national companies. So when we look at that, if for a company, major U.S. producer, if the decision for investing in resources is go, they take the risks, they are resilient, they make all these decisions in advance, and they go fully in. But however, with regard to national companies, while they get a benefit from subsidies or government supporting, sometimes the change of policy in these governments, economic pressure, change of prices, change of policy could impact their decisions. So I would say, looking at it as a strategist for U.S. energy, while in U.S. we cannot, and so far we did not have a national energy strategy, and our energy strategy swings drastically from one administration to the other administration, I would say the fact that most of the resources in US are private and are privately run by these energy companies, and decision is market-based and based on what they think is good, that kind of gives some certainty and some ground to what is U.S. position in terms of production, in terms of major energy factors. But definitely, when it comes to infrastructures, I would say the countries and those governments, that national companies, are involved in terms of infrastructure expansions and integration. It's much faster than US, and some of the hiccups that we have in US was again alluded to is a infrastructural issue. So I would say that's a challenge, because in US, especially with different territories, different states and regulations, is not that easy to expand the infrastructure, especially the midstream, and integrate them as fast as the national companies.
Yeah, no, that's actually
Excellent point.
yeah, it's a great point. It's an elegant point, because that is something a lot of outside objective viewers of the energy markets don't understand, is that the U.S. is kind of an amalgamation of a bunch of independent decisions. And sometimes you'll have some decisions that are just based on budgets, because they budgeted it, they'll drill it, even though it's uneconomic. And there's a lot of disassociated decisions that are happening versus a national oil company, which is one big decision. So thank you, Sara. Let's see. Let's go to Mike McGlone in sunny Miami, and there's a current bearish outlook for crude in 2025. And if you look at the forward curve, it's always gone down. And as we've gotten to the prompt month, it's always gotten higher. So the question really remains, what is in your crystal ball? Because you are one of the top energy analysts when it comes to price projection. What is actually happening? You're a strategic thinker there. So I really want to get into your headspace and kind of understand, what are you looking for in 2025 in the WTI market, the Brent market, and what are the factors that would drive it up or down?
So I really appreciate that question, Brian, and I really appreciate the comments from Brian and Sara and you. And the key thing that really struck me, solidifies my view that all markets are supply and demand things are very backward looking, and all the analysts often have to try to project forward. But the most significant factor in all commodities is price. And that's from a guy who comes from a farm background, and I sold my farm a few years ago. But it's a key thing that Richard said. Profitable for all. The key thing that Sara said, most energy sources in the US are private decisions and are market-based. And the key thing you said, an amalgamation of a bunch of independent decisions. It solidifies my view that prices are still on the back end of a massive pump we had to 2022. And Richard kind of hinted that before he started in the business during the Iran-Iraq war. We pumped up to 30, and we bottomed around 10 years later. Or Saddam Hussein's invasion of Kuwait pumped up to 40. The bottom was about $10 a year, $10, who knows what, 8 years later.
Mm-hmm.
We're in that stage right now of heading towards the cost of production. In the US, it's $56 a barrel. You basically have to get below that level to offset this fact of increasing supply, diminishing demand. Then you look over, what's the major source of demand in the world? China. What are they importing? 11 million barrels a day. It's the same as 4 years ago. What has been Japan? They're turning Japanese. Just look at their bond market. So we have a clear transmogrification and paradigm shift going on in the world, which we talked about earlier, is going to get prices to do what they normally do. They have to get cheap to reset these forces. So Richard touched on this earlier, but I have to sometimes, the one thing I have to remember is, I point out, I'm an ex-trader, ex-investor. No, I just say it. I completely respect for people like you and our listeners and viewers who do it. But I have to be provocative, and I fully expect this whole series, this whole cycle is not going to be over until we get prices relatively cheap. But that's not profound. It's usually what happens, which means $40 a barrel in WTI. The consensus this year is around 70, a little bit below. For Brent, it's around 72, as I see on the terminal. That's for the end of the year. And the question is, what stops it? So I'll focus on the elephant in the room. Now, those are some of the major things. The elephant in the room right now is the potential for the U.S. stock market to go down. The first prerequisite for all commodities, i.e. most notably the economic sensitive ones, copper and crude oil, go up, is the U.S. stock market has to go up. Now, we didn't do that last year, and they went down. Copper went up a little bit, crude oil went down anyhow. Now, my chief market strategist, Gina Martin Adams, who at Bloomberg, I been watching for 8 years, who's been spot on. His bearish the U.S. equity market. That's a oxymoron for her. She's been spot on. She's turned bearish. So if the stock market has, say, an 8 to 10% correction, crude oil is going to drop 20% unless there's a supply shock. That's just the way it works in a market where we have the whole world elevated by U.S. equity. So the macro, the micro, everything to me for crude oil is somewhat bearish. That's why I have to turn to myself. Okay, what am I missing? Am I too bearish? And so I just look at things I published about recently. We have a increasing upward trajectory in the exports of U.S. Supply surplus from U.S., Canada, obviously many Guyana, you name mentioned. It's just clearly upward to the right. And we have an increasing dependency in OPEC to cut supply. And we have an increasing dependency for more and more stimulus from China. That's a deflationary trend. And I look at bond yields in China, 1.64%, 300 basis points below the U.S. Severe deflation in the world's most demand-pulled commodity source. So I started honing my views on China almost 15 years ago when I went there for the first time, because it's just what I remember, having worked with the Japanese forever. It's just the same kind of thing, but much more extreme. Japanese GDP at $4 trillion is the same as it was 30 years ago. China's doing that now, but it's in the reversion stage. So I don't know what gets crude oil to go up other than some kind of supply shock. I think the trend's lower. I see the similar thing in grains, oversupply in the back of the massive pump. And I'll end with this. It's 2 books have really solidified my macro views. Number one, it's always been price matters the most. And one was The Price of Tomorrow by Jeff Booth, by pointing out how, great Canadian, pointing out technology is moving so fast. And you see that every day with drilling technology and just what's happening in the U.S., declining demand for fossil fuels, increasing supply. And The Price of 3 books. The Price of Tomorrow by Edward Chancellor, about how big booms and busts always go lower. That's where China is right now. And The Domino Effect by Chancellor, what was his name? Berzera was his name. Just that technology of drilling it's trickling over to geothermal now. It's just unstoppable. So key thing to watch is natural gas. Can natural gas in the U.S. stay above 4? Typically drops down to 2 after it goes to 4. Can Brent stay above 8? So these are resistance levels I'm putting in the market. Can Brent stay above 80? It needs to do that to show bull market. Otherwise, it's probably going to get cheaper. And that's why I see almost all commodities. I think, unfortunately, the one commodity is going to still outperform in everything is gold.
Yeah, I can definitely see that. So my great thoughts, great questions there. And you touched on something that that is really top of mind, and especially as we're transitioning from one president regime to another. And as we look at Trump 2.0, we are looking at kind of a more friendly policy environment for energy. And Richard, when we are looking at some of the policies that are going forward that might be friendly on the Trump 2.0, I want you to speak a little bit about sustainability. You're sitting in California. That's been a topic in California, is on sustainability, as well as in the United States. Energy transition, there's been so much economic momentum towards energy transition, and then energy infrastructure, which is something Sara touched on.
I lost you for a second here. So
okay. Can you hear us now?
Now, yeah. Here you go. Yep.
Okay. So Richard, I want to see if you could touch on 3 things. One is sustainability. We're kind of transitioning from a presidency that is really pushing forward the energy transition away from fossil fuels, and then infrastructure, which is something Sara touched on, which is some of the infrastructure constraints that we have in the United States, as well as export constraints. So I wanted to see if you could touch on those and what is in your crystal ball for 2025.
Excellent point. I think Sara and Mike made an excellent point about the stock market. I think he's exactly right about that. That's a point to talk about. I think one of the other issues is, and Sarah's point about infrastructure, I think they're brilliant points. We saw the Keystone Pipeline, right? The Keystone Pipeline has come and gone because Mountain Pipeline has been built now. And so instead of taking the dirtiest oil in the world from the oil sands and taking it to the most sophisticated, regulated refinery systems in the world in Houston, taking it through the San Juan Islands. Let's take the heaviest crude, take it through Vancouver, the most pristine area of North America, and take heavy tankers over to the most least sophisticated refiners in China. So great plan there that worked out. So it's, to me, the green agenda, I think I find the green agenda to be not just anti-competitive, but I think wrong-headed. I think that's the big thing that's going to change. I think that most likely China is going to electric cars because they can mandate their people to buy what they can buy and they don't have to buy oil. So, I think that really the focus should now be on India, Indonesia, and Africa as far as oil is concerned. But as it relates to sustainability, I think we're going to see now with Trudeau gone that we're looking at a country, two countries now. They're going to be really putting serious money behind infrastructure. I think there's going to be a partnership now between Canada and the U.S. And I think a lot of the states are going to get in line, and that's going to be very, very important. I think that's the key here. And so I think under a Trump presidency, they're going to get rid of the regulations, and it's going to be much easier to do whatever oil companies want to do. And again, Mike's point was excellent as it relates to the stock market. I tend to think that's probably could be one of the greater things where people just get short. Markets are in backwardation because the prop supply is tight. So you have to ask yourself. So we can talk all day long about what's going to happen, but as long as the market's in backwardation, that means that someone's keeping barrels off the market on a prompt basis. And so if prices start to fall, if people decide they want to bring does production come down? Does OPEC dial it down one more time? And I think two things have happened there is one, we had a very, very sophisticated option market forward for decades in the US. And that I see something just came up in front of me.
Oh, yeah. I'll read it after you finish your point. It's going to be our poll.
Good. So I think the option market was a sophisticated option market historically. That doesn't exist anymore. We're not seeing a lot of forward. I don't believe we're seeing a lot of forward hedging anymore. Forward hedging was always a kind of a factor where people jumped on, Mexico in particular, but other large producers were always hedging forward. And I think that's not happening anymore. One of the reasons due to a backwardation market. Why so forward if the price is always more expensive when it gets prompt? And so I think that's one issue. But as it relates to the U.S., I think that our energy GDP ratio is minimal, right? Demand is going to go up just a small amount. It's going to be elsewhere. So when you say sustainability, what does that mean? Sustainability. I mean, I think it's a world oil market. I think that the infrastructure being built around biofuels and hydrogen highway, I think are not going to go any further. I think that in the U.S. in particular, I think the money is not going to be there anymore. Every single major financial institution is dropping out of the DEI energy agendas that they had to put for the CEC. The CEC was making them come up with an energy DEI energy agenda in their bookkeeping. That's all going to go away. So I think what we're faced with is, and I give Mike the point on it, is what happens to the stock market? How does that affect oil? I think as far as it relates to what we're going to see from Trump, it's going to be not drill baby drill, but export baby export. And I think that export baby export is going to come in the form of LNG. I think that's where we're going to start to see a significant increase in U.S. infrastructure and U.S. sustainability.
Yeah, no, I think that's a great point. So let me read off our today's survey, or not today's one of today's survey, this panel's survey. How is the U.S. energy industry most likely to respond to Trump drill baby drill strategy for expanded oil production in 2025? Is it accelerating? Is it accelerating drilling production in key regions like the Permian Basin despite infrastructure bottlenecks? Prioritizing shareholder returns over aggressive production growth to maintain financial stability? Balancing increased production demands with investments in low carbon and sustainable energy initiatives? Or 4, expanding export capacity through strategic investments in pipelines and VLCC capable terminals? So I'll let y'all answer that. But Sara, I wanted to pick your brain a little bit on sustainability and on the energy transition, and what do you see in 2025 in the United States as far as a changing position from one presidential regime to another? How do you see that translate to investments into the energy space for 2025?
I like how you call them presidential regimes. It actually sounds like that, because there is a significant change. It's like almost a total change of policy. So I think everyone pretty much expects, what will happen in terms of U.S. Position, in terms of its energy diplomacy when it comes toward sustainability or international regulations, let's say COP. So would the U.S. sustain COP, a Paris Agreement or not? It's irrelevant, really, because definitely everybody expects that President Trump is not going to be religious green like President Biden, and have a more pragmatic approach toward the energy industry. There are definitely going to be some changes, perhaps, let's say, some of those incentives that have been set for incentivizing green energy, let's say EVs being undone by President Trump, or investments. We already see, before even President Trump taking office, most of the banks left net zero banking alliances, because that definitely creates hurdles for their profitabilities, and also put them in a threat of political, backlash, or even being threatened as antitrust, being just working together for climate change issues. However, what I think is that, when we talk a lot about supply-demand, market-based energy transition, we just tend, as you asked me, 2025. So what I like to emphasize is just, while we're talking, we need to really make sure which timeline we are looking. In short term, in the next couple of years, okay, we might all expect that there is a huge change of, let's say, deregulations that would reduce the cost for producers. Fossil fuel producers, a lot of incentives that have been allocated for renewable energies within the United States being undone. So we can expect all of this within the short term. This is same as the discussions we had together just in the first 15 minutes of what will happen to U.S. production, at least oil or export of LNG. However, if we want to stretch the time to, let's say, beyond 5 years to let's say 10 years, things could drastically change. I don't think President Trump's second term is about oil or even natural gas. It's a lot about supply of electricity. And it's a lot about securing this electricity supply that we need for long term. And as we see this time, is not oil companies that are really main supporters of President Trump, are tech companies. And we are going to have a significant demand. I do remember I raised this issue early 2023, that we do not have any methodology to anticipate and forecast the demand, electricity demand for AI. Is 2025. We still don't have any methodology to look into our forecast for AI, and very comfortably everybody just discounts that we are not putting AI's demand in our forecast. We have an understanding of how much data centers need energy. For instance, if you ask the US electric, and that's how we try to understand, we talk a lot with electricity companies, the distributors. You're like, okay, how much electricity do you need to produce to supply the demand for North Virginia, just North Virginia? And they do not have a clue. Only they know that for the contracts, the data centers that have already been under contract, not any additional data centers, and this is not AI, just for the data centers under contract, we need additional 24 gigawatts of electricity, just in North Virginia by mid-2030s. And for that, but just for North Virginia, we would need additional, just to put it in a context, 26 to 30 nuclear power plants.
Yep.
So it tells us that even this optimism for President Trump is going to cause additional or surge in LNG export. It might be temporary for short term. But if you're Japan and your electricity demand after years of declining is now increasing because of electrification, because of data centers, offshoring, you are going to rely on US long-term, at least for the next 10 years of LNG supply, wishful thinking. You know, maybe Democrats put a ban on LNG, additional LNG permits. They came with a discussion of methane emissions that would justify their decision. I would say going, if like, I mean, President Trump's next year is just 4 years, but I would say that US long-term, we would put, I mean, Republican would put some sort of other bans on LNG export if we wanted to have a steady electricity prices within the United States. So I'm always like, I always like to look at the all these forecasts and views within the time frame, not just short term, this year, next year, but within the long term. And what I think, going back to your question, was about sustainability. As much as we are all pessimistic about, let's say, growth of energy, green energy in the United States in the next few years under President Trump, I think because of the increasing demand for electricity, and which ultimately would increase the prices, we're going to see a lot of surge in green power generation. If I wanted to have a sustainable, for my household, electricity prices, I would look into like having, let's say, solar panel installed. So I would say without needing incentivizing green energy and renewable energy, the sheer demand in the medium term to long term for fossil fuels and natural gas especially, and electricity prices will incentivize, the market will incentivize the use of renewable energy by individuals and industries.
Yep. Fantastic. Sara, thanks so much. Listen, the poll will be posted out there. I do want to save the last word for Mike McGlone. We're short on time. Bull, bear 2025. What's the call?
Bearish virtually all risk assets and deflation kicking in. The U.S. stock market has to go up. It risks going lower. Key thing to remember about Trump and tariffs is from the Robert Lighthizer book, No Trade is Free. Expect him to swing really hard and do tariffs right away. This is a very emboldened human being. You're seeing those in the headlines. And all the other things he wants to do takes acts of Congress and may take years to really matter, like lower taxes and regulation and stuff. But key things to really note from what just really what Richard said about backwardation. Part of the reason there's backwardation in crude and a lot of the grains is because the producers are selling forward, so they're already locking in their profits. And the key thing to remember about LNG, key thing that Sara noted rapidly. Trump didn't get elected by the rest of the world. He got elected by U.S. So having lower energy prices means the bottleneck should increase in the U.S. There's a bottleneck of energy, right. LNG. We only export 10% of our natural gas through LNG. Maybe that increases a little bit. But if natural gas prices go up because we export more, that's not going to help Trump's constituents, and that's who voted for him.
Yep. So that is great.
Yeah.
Listen, Mike, that is fantastic. Sara, Richard, Mike, thank you so much. I wish we could have all day to discuss this because I think this room could solve a lot of forward-looking issues. So thanks so much for joining us. Really appreciate it, and have a fantastic day.
Thank you.
Thank you.